Hello, everyone, and welcome to the Credit Building is Asset Building webinar. We have 800 people who have signed on to be a part of this, but we're not quite there yet in terms of our numbers, but there is a lot of interest in this topic, and we're very thankful to NeighborWorks, our sponsor of this webinar series, for working with us on such a great webinar and a wonderful speaker lineup. So the purpose of this webinar is really to look at a set of core issues. First, the aftermath of the housing crisis and the prevalence of predatory and payday lenders has left many low and middle income consumers with damaged credit. This is particularly problematic as a solid credit score is essential for the ability to purchase other assets that build financial security, for example, being able to buy a home or a car or to start a small business. Today we will hear from experts in the field of credit building and repair about promising strategies and products that are helping Americans rebuild their credit and financial stability. And thanks again to NeighborWorks America for their support of this webinar. So let me get started with just a little bit of housekeeping. Some of you know this drill already, some of you may be new, so I want to make sure we cover it. This webinar is being recorded, and the webinar recording and PowerPoint presentation will be available on both CFPB's and NeighborWorks America's website. All webinar attendees are muted to ensure sound quality. If you are experiencing any trouble dialing in, you can listen to the webinar by connecting speakers or a headset to your computer. And again, we are here, so if you experience any technical issues, please email webinars@cfpb.org, and we'll make sure that you get some assistance immediately. We're going to hold questions until the end of the presentation, so we do have a number of slides to get through today, but we really do encourage you to submit questions, and we will facilitate that by having you ask a question by clicking on questions in the GoToWebinar control panel and then typing your questions into the text box. We're going to be monitoring them throughout the presentation and actually keeping a list of them so that when I do the moderation of the Q&A, at the end we'll have them all ready to go. So you can submit your questions at any time during the webinar since we will be receiving them. And I am Kim Pate, your moderator today. I'm the Chief External Relations Officer at CFPB. And I'm happy to have Vicki Frank, the Executive Director of Credit Builders Alliance, speaking with us today, as well as Nancy Yule, the Executive Director of Innovative Changes. And I'm going to turn it over to Vicki right now without any further ado.
Hi all, this is Vicki Frank. I am thrilled to be here and have the technology working. I know that Kim just took a moment to introduce us, so I will jump in. And I'm jumping in here with just a question that we've been looking at around what is credit. Certainly having been the founding executive director of Credit Builders Alliance, I've had to think about what this word means a lot. And I think we've learned that we all have so many meanings to it. And every day, depending on our mood, the last client that we just talked to, the last loan that we just tried to apply for, we may have different terms for it. Some of us may be thinking about debt. Some of us may be thinking about spending, credit cards, score, report. So I wanted to kind of get us all on the same page. And I went back to the dictionary, if anyone's ever seen one of those. And really thinking about it helped me think about it in terms of the words trust and value and worth. And so how do we take this concept of credit as being credibility, trustworthiness, showing that we're trustworthy and value and worth in this world where it has taken on so many meanings and has so many different forms. And so I kind of wanted us to start there as we're starting to think about what it means for credit building to be asset building, because that's the mission of our organization. And back in 2005, 2006, we created this mission for creating innovative solutions for asset building organizations, nonprofits like many of you on the phone, to help you help your low and moderate income families build stronger credit in order to not just have financial access, but really to grow business and personal assets. And so this was one of the first times, me having been a practitioner before that, when I was really trying to think about credit not as debt, not as that liability, but on the asset side of my balance sheet. Like, what does it mean for credit to be an asset? And that was something that we started forming, that concept, in 2006 and 2007. Now that you know a little bit about me, I'd love to know just a little bit about who is on this call. So we're going to have a webinar poll that we're going to launch right now. And I'd love you to pick all that apply, whether you're doing housing, counseling, match savings, so really helping consumers save and however you help them save through IDAs, through other kinds of savings initiatives, whether you're providing financial coaching, affordable housing rentals, and microloans and/or consumer loans. So feel free to take about 30 seconds. It's really exciting how many people are on this webinar today. I don't think I've been doing webinars for about the last 10 years in the asset building field, and I know Kim Pate has as well, and we haven't seen registrations like this, so we're really exciting. It's really exciting to see how many people are interested in credit building, and we know how diverse many of you are on this call. So we're going to go and see how diverse you really are. It's exciting. I think that we had 7 pilot groups back in 2007 who were all micro lenders, and now we can see that we have, so 56% of you are doing housing counseling, almost 50% doing match savings, over nearly 80% of you doing financial coaching. We have about 25% of you have affordable housing rentals, so it's not in this presentation, but I'll refer to some upcoming opportunities around the power of rent, and then about 25% of you are actually making loans. We have a pretty great diversity here. Thank you. So CBA started with the credit building from the perspective of working with the credit bureaus and micro lenders in terms of thinking about what it means to add positive data. And so we started with that process of helping micro lenders who have small portfolios but were doing amazing loans to low-income entrepreneurs and families around housing, and we wanted them to be able to not just build a credit history with them, but build a credit history with the world so that their clients could access mortgages, could access other kinds of business capital. And so when we did that, we got this amazing cultural experience, but we were thrilled that we could be part of the process in helping so many low-income entrepreneurs and consumers build credit. We now have 16,000 loans that go through us every month, and we help nonprofits pull over 50,000 credit reports. But we were also curious why we were needed, what was happening in the economy that required an intermediary like CBA to support nonprofits throughout the United States with respect to access to data and reporting data with the major credit bureaus. So the next poll that we're going to do is more of a credit quiz. We made the first one easy, this one's a little harder. But which of the following is calculated in a credit score? So pick one, A, character, B, capacity, B, capital, C, collateral, E, none of the above. And so we'll give you all just a minute or 2 to 30 seconds to answer this question. It's exciting how many of you are voting, and it's exciting how many people are on this call. So we'll show the results. So what we're seeing here is that so 13% of you said character. And there's obviously aspects of character that are on a credit report. We know that people's payment behavior, whether they've taken out a loan that they can afford, all kind of allude to their character. But we know when we think about people's character that it's much broader than just how they pay a loan or whether they take that. And we know that there's a lot of other things that were happening in the economy over the last 5 years that encourage a lot of people to refinance mortgages from a 30-year fixed into a much more subprime mortgage that they didn't have the capacity to pay. That may really not have as much to do with people's character, but the economy that we were living in, the times that we were living in. The capacity is a really interesting one. The traditional definition of capacity when you're thinking about this with respect to access to credit is really, do you have the money to pay? And therefore, income is really the biggest component of that. And income is no place on a credit report, and therefore it's not integrated into a credit score. You can assume if another lender looks at somebody's income and gave them a credit line or a form of credit, what their capacity might be, but you also don't really know what they can somebody else assess them for paying. And now, as hopefully many of you know, through the Dodd-Frank Act, all lenders are now required to verify income and capacity to pay, and not just use information on the credit score and make assumptions. Capital is an interesting one. That's cash in the bank. That's that savings that all of you IDA practitioners and max savings practitioners are doing. And actually, there's no information about capital anywhere on the credit report. Therefore, it doesn't go into any of the traditional credit scores. Collateral, a few of you said that. Actually, that's one that we often see more, because clearly you can see when a mortgage or a car loan is taken out, you know somebody might have some equity or capital or collateral. But generally, what you're seeing is how much they owe, and you don't actually see what the value of the house is or the car is what collateral they might have within that equity or that asset. So for many of you, we have 40%, so not quite the majority of you, but a big chunk of you said none of the above. And so I think that that's really interesting to think about. So what is a credit score if it's not these 4 C's of underwriting? What does it mean to our understanding of it? And how does that play into the economy? So one of the things that we've noticed is that it really plays into this idea that to have good credit, you need to have good positive information. All the scores are looking at is data on a credit report. And if there is no positive data, if you're an entrepreneur or a consumer in a community that doesn't have access to bank loans or other kinds of traditional credit that reports to the credit bureau, so you have no possible way of having anything positive on your credit report. And I don't care how good or bad a scoring algorithm is, if there's no good information, data in, data out, you can never have a good score. And so it's really a catch-22 situation that you need to have good positive information. But most of us, when we're working with our clients, we're so focused on the negative, on the debt, on the people who are delinquent and not paying well. And we know so many of you are dealing with foreclosure and crises. And so what happens when they go through that? They go through bankruptcy, they go through foreclosure. Now nobody trusts them. Now nobody wants to give them that trusted relationship that they can start to build positive information again. And so this is really a catch-22 that's really helped us think about why credit is so important as an asset. So one of the things that Credit Builders Alliance has been thinking about a lot, and we've kind of created this 5-step. And this is both a 5-step for organizations to think about what kinds of products or activities you're doing that can actually build credit, and we'll define that in the next couple of slides. But also, we've been using this 5-step as a way that practitioners can look at each individual client to coach them through a process of understanding for each and every individual how credit can be an asset for them and what they need to know about credit reports and scores in order, and what opportunities and trusted relationships they need to build to be able to get something good going. And so that's really exciting. So let's go through this. We only have about 15 minutes. This is obviously not our full training. But the first thing is really how is credit a financial asset? And so what kind of savings? I think that's the most exciting thing for us in the assets world is that credit is about savings. It's about finding places to lower your monthly car payments, about being able to rent apartments in schools, in communities with good schools, and it's about saving people time to get to work. And it's also about savings. People save a lot of money, and then they have to give it away to the utility company as a deposit instead of keeping that in their own savings account for emergencies or retirement or other asset building. So let's look at, in one car loan over 5 years, we can see an incredible difference in a monthly payment from somebody who has a low score and goes to that used car dealer down the street and has no idea what their interest rate is, to somebody who has a relationship maybe with a credit union and can go in with a 5%. Here, I can afford this car, this amount. You can see that the monthly payments are almost $100 different, which we know for many of our low-income consumers and families that we're working with is a huge amount in their budget that they could be using for better things. And then over 5 years, that turns into over $6,000 in savings. So as you think about helping people in that savings account want to save a few $1,000s, this is an amazing opportunity. The earlier you can get people into better credit building, then they can start saving more money. And then obviously for those of you in housing counseling and thinking about that mortgage, we know how hard we work to get everybody into a prime mortgage so that they're saving up to $100,000 on their home over the mortgage. But again, significant monthly savings of several $100s each month as we can move them from a subprime to a near prime, which is a 620 score, into a prime score. And this is information that we just got from myfico.com, so it's a great tool for people to go there when you're working with your clients and show them that if they could just get their credit score up a little bit, the kinds of savings that they can expect over time. So, we know that it connects very closely to the kinds of assets that we're building in terms of home ownership, businesses that almost always require cars, workforce development, people, what goes into a budget. We obviously know that employers look at credit reports, and we have a lot of wonderful stories, some of which I'll show you at the end of this presentation, in terms of people who have gotten better jobs, and gotten a job, gotten a raise at their job because of having a good credit score, getting deposits back to the utilities. There's a new law in Oregon where anybody who thinks that their credit score has improved can go back to their insurance company once a year, and the insurance company must review the credit score and potentially reduce the rate, but they may not increase the rate. And so it's a win-win for consumers if they've been able to improve their score since they first got their home or car insurance. So those are really great opportunities. So, we know how much it costs people, right, where they're spending their money when they don't have good credit. Somebody with great credit can get that credit card in their pocket. They can use it over 30 days as a cash management tool, and they're paying 0% if they're paying in full at the end of every month, and they don't carry a balance, and they don't stay in debt. That's 2 payday loans. That's right. That's 2 weeks plus 2 weeks at 0% for those of us who have good credit, who can manage a credit card that way. Obviously, that's a wonderful goal. And how do we make that a goal for all of our clients, or at least envision it as being a goal for all of our clients? Well, we obviously understand that many of our clients are mired in a credit card balance that are paying 22% APR, and if they're paying late fees, they can obviously be paying a lot higher than that. So that the other alternatives to not even being in the mainstream kind of start at the minimum of 400% when you start looking at the payday loans, and they can go up as high as 700%. So there's a huge two-tier financial system here that we know is working out there, and we need to figure out how we can make it work for our clients, and how we can get them into the tier of banking and financial services, which may be traditional or non-traditional, but that really works for them in a much more cost-effective way. So from our perspective, our definition of credit building, we recognize that there's lots of ways to damage or repair your credit, but there's really only one way to build credit, and that's that on-time payments reported to a credit bureau every month build credit. And so then how do we help our consumers, our families, our entrepreneurs get there? And one of the tools that we've been working with financial coaches is really helping people see their credit report as a financial resume, as something that, what do we want it to look like in 2 years? What skills do we need to have it on there? Less of a focus on what we're getting off of it and what we're putting onto it. So we're building credibility. And just as we all know, unfortunately, with work resumes, it's very similar to financial resumes. Sometimes the most critical thing on a resume that people look at is not even what's on the resume, it's why there's a gap, right? That question of why weren't you working for 2 years? We often are much more responsive to somebody having been laid off, right? We know that that's happening, to somebody having lost a job. And how are we helping them move forward immediately in a new job, right? How are we helping them not have a gap on their resume and in their income? And it's very similar with a financial resume or a credit report. We need to provide that opportunity for people to not have a gap, to start building their credit worthiness again in a trusting relationship. And nonprofits, through financial education and financial coaching, really have an opportunity to help that. And we're seeing a lot of different really exciting new innovations and new strategies come up. And based on the basic tools that CBA set up on our platform, we're seeing just a lot of organizations taking those tools in ways that we never even envisioned, and it's so exciting. So I'm going to share some of that with you in terms of a couple of client stories. So this is the one that kind of started a lot of this. And Justine Peterson Housing is an organization in St. Louis. They are one of the most underbanked cities in the country. So they have a lot of working class families coming to them who have income and just don't have any access to financial institutions, and therefore potential for good credit. So this is an example of a client who came in, and then within that first visit, they're pulling that credit report immediately. They can't even envision doing financial counseling without having somebody's financial resume in front of them. It's a requirement that every immediate new client has to pay that $10 to get their credit report pulled so that they can start from there. They spend a lot of time explaining to people the savings and if you want to get a mortgage, you're going to really need to have a good credit score. 513 is not going to get you there, but in 6 months, it can get you there if you do some things like opening up. They offer a small credit builder loan of about $150. They also have a partnership with U.S. Bank. They also have a partnership with the Cities platform, and it's really exciting. They're actually creating a platform, and they just, in the last year, onboarded 20 other nonprofits around the United States and in Chicago to start testing the platform for other nonprofits. And I think that they'll be talking about that at the Access Learning Conference and also expanding that in years to come. So within 6 months of having going from a credit report that did not have any good credit but had some collections on it to a place where they were making on-time payments for 6 months, you can see that there was over a 100-point jump in the credit score. And we see this a lot. This is not just a one client out there. I have 100 of these stories. I unfortunately don't have a lot of more quantitative aggregate numbers, but we're working on that with some of our partners. So we have a lot of these anecdotal and quantitative stories for each individual. At the same time, they started helping them dispute some of the collections and pay off some of the collections. Started working on a business plan with this person because they decided they needed to change their income before being able to buy a home. You can see that there's a little bit more of a pop-up on the score when they were able to dispute and clear up some of the collections, but a lot of that what's driving that score is that on-time payment. So this is probably an example that many of you are familiar with. You work very hard with a client who wants to buy a home and then wants to start a business, and you're providing a lot of technical assistance and financial education and housing counseling and business technical assistance, and then they disappear. And for many of us, then we don't have those outcomes that our funders are looking for, that our programs are looking for. And what's exciting about this, as you can see, is that they have this credit as an asset. They can really see that they improved this person's financial education. What's so exciting is that this client disappeared for 2 years, and 2.5 years later walked back in. And the 1-year loan was gone, but they still had their credit card, and they were using it perfectly every month, not carrying a balance, and their score had continued to grow. And they were still in a place that if they wanted to buy a home or get a business loan, they had the financial capacity to do that. And then they found out that they were pregnant with twins, and they disappeared again. You'll all be excited to know that sometime in 2010 they did finally buy their home, and they've had the credit score to get them there and throughout the environment. And so that's been a really exciting opportunity that somebody comes back a year and a half, 2 years later, and you can see the financial capability that you created. And so that's really when we start to talk about what does it mean to do financial counseling versus financial capability, is really about those integrated services. How are you figuring out how to, if you're emphasizing good credit and good financial management and paying your bills on time, whatever those bills are in your technical assistance and education, how are you helping your clients have an opportunity to physically demonstrate that with each monthly payment? And so that's really what this example shows, and it's just an exciting opportunity, I know, for many of you to think about how you're working with your clients. So after you're thinking about how to get something good going, for some clients it's really about an action plan that you're going to need to put into place, and you can just see in this example how Citizen Potawatomi has a partnership with their tribe, that any employee of the tribe can take out an employee loan, and so instead of it being an advance, it's a loan that the CDFI makes. And so they have to give a loan to anybody who's an employee, even if they have a 476 credit score. But then they get the opportunity to work with this person. They get that opportunity to help that person think about savings, to plan for the ITC refund. You can see in this case, they were both able to set up this employed woman who had a lot of debt, was very low income, and got a full ITC refund, also saved in an IBA match savings account, which in this case is privately funded, so they could use it to pay back debt. And then at the same time be paying off this employee loan that was being reported to the credit bureau. A lot of work, but you can see kind of what kind of action planning can happen over a 12-month to 14-month period to really help somebody get out of debt, begin being a saver, and also build a credit score. So those are 3 valuable ways of building your assets and your balance sheet and your income. So I'm not going to go through all these stories, but this is another example of where an action plan included a savings, included a loan, included a secured credit card, included a car loan. So you can see how people are really adding on the assets. That they're starting with somebody with no assets, no credit score, no checking account, and they're making a transition from that person over time and adding things as they can. And you can see in this example as well as the others that loan is that the first thing that happens in this case is from March 09, that vested, that $800 loan. So that's a little bit backwards for how some of us often work. We often think about payback and then save and then think about the loan. And we're seeing that to build a credit score takes time. The outcomes take time. So you can see this is kind of moving us into step 5, how people are integrating their activities into very measurable outcomes. And so as their action plan really leads to outcomes, both for the client as well as for their story of their organization. We have a lot of these and wonderful pictures. I'm not going to go through all of them, but I just wanted to show some of the diversity of the kinds of organizations, from domestic violence to workforce development to housing counseling to IDA, that have found unique and innovative ways to do this. And we challenge all of you to be part of this. We actually have a Score to Save campaign going on right now, so many of these stories came through that. Actually, I think right now we have a campaign or a challenge till August 1st, although we're probably, given this webinar and all the excitement, going to give you guys a few more days that we'll announce soon. But you can actually win a full scholarship to present at the CFPB Asset Learning Conference in mid-September if you submit a story. We've already got some stories coming in, but we want a lot more. And it's really a great way for you to think about what you're doing about building credit and how that's actually helping people save. And we're happy to email us or call us. We're happy to coach you through how to do that story. And we'll be obviously we'll be doing a whole presentation on it at the Asset Learning Conference for those of you who aren't quite ready but want to start thinking about integrating it in the fiscal year 2013. So there are 3 ways that nonprofits have become part of CDA. We allow and enable any nonprofit or government agency or credit union or tribal entity who are lending either consumer or micro business loans to report through us, regardless of the size of your portfolio. We provide 100% service from soup to nuts, day one, through the credentialing to helping you understand what your requirements are, and we're really excited to work with all nonprofits in that way if you decide to add any kind of, and we've had some domestic violence organizations that were never even thinking about being a lender learn about this opportunity and start supporting, and we'll be highlighting them at the Institute at the Asset Learning Conference. CDA Access allows nonprofits to actually pull soft inquiry credit reports for financial coaching and outcome tracking, as well as for lenders the hard inquiry. And so that's a special relationship that we have with TransUnion particularly, as well as some other, and we're happy to make that available to nonprofits, although there's many hundreds of people on this call, so please don't all call us tomorrow. And then, being a CDA member, we do a lot of training, we do a lot of webinars and workshops. As I mentioned, we're going to, I think, presenting every day at the Asset Learning Conference. It'll be credit building every day at the conference for those of you who are interested, and we'll be having an exhibit booth, and we'll be working with people to develop your own outcome tracking, your own, and helping you think about how you want to be a credit builder. So if you're interested in that, we'll have a booth set up at the conference to help people think about what's the best way for your organization to become a credit builder. I'm really excited to now pass the wands of this presentation over to one of our members who's using all of our activities. So this is an organization, it's a brand new CDFI, probably the first one that's making only consumer loans and payday alternative loans. They started reporting those loans as installment loans over time, giving people an opportunity to get out of debt, deal with their debt, build credit, start to budget. They're pulling credit reports for both financial coaching as well as their own outcome tracking, so they can see when people are building credit and can move on to the next step where they can get a better loan because they have a better credit score, and you can kind of see over time all the things they've helped Anita with. They fortunately have hundreds of clients like Anita over the last couple of years. It's a very exciting initiative that works in conjunction in Oregon with 40 or 50 nonprofit housing nonprofit partners that are all referral partners, including many housing counseling organizations, IDA organizations. This is really a one-stop shop in Oregon. We're really excited to introduce Nancy Yell, to tell you a little bit more about innovative changes and a lot more about the products that they're offering to clients and home buyers and micro entrepreneurs all throughout Oregon.
Thanks, Vicki. Hello, everyone. I'm Nancy Ewell, the Executive Director of Innovative Changes, and I'm just thrilled to be here with you today. So thank you to CFED and NeighborWorks for making this possible. As Vicki mentioned, Innovative Changes is a community development financial institution. We were founded in 2009. We were founded by Innovative Housing, which is a provider of affordable housing here in Portland, Oregon. And the folks at Innovative Housing found that their residents were really struggling with low levels of financial literacy and having a hard time making ends meet. so their residents were often turning to payday lenders and getting caught in the cycle of predatory lending. So Innovative Housing decided to create an alternative to payday lenders, a lender with a difference. And the difference is that we make responsible, affordable loans combined with in-touch financial education so people can achieve and maintain household stability. We offer 3 synergistic programs. Our financial education provides workshops, seminars, and coaching to help people make ends meet, build budgets, assess banking relationships, prioritize savings, and manage, repair, and build credit. Our credit program offers 2 main loans, which we'll talk about today. And we also offer individual development accounts, or IDAs, for post-secondary education. Our strengths are grounded in our partner network. We currently have 37 referring partners, which include affordable housing resident service providers, social service agencies, and asset building programs such as home buyer readiness programs and micro enterprise programs. And we run our programs in tandem with them. So we cross-refer to provide a more holistic set of products and services to the clients. We'll talk more about the importance of referrals a little later. We believe that all of our programs contribute to asset building. In financial education, we help people identify spending leaks and find opportunities to save money. In our asset building program, we help people fund post-secondary education so they can move into a better paying job. And in our credit program, we help people pay down high-cost debt and establish good credit scores so they can access asset building investments, because a good credit score is an asset. And as you'll see with our credit builder loan, the loan is also a de facto savings product. We are licensed by the state of Oregon to provide consumer finance loans, and our opportunity loan is a small dollar installment loan that helps people take advantage of opportunities to improve their situation. We're flexible in the use of the loan so that we can respond to the unique needs of each borrower. Housing-related costs, auto repair, and medical expenses are some of the most common uses. The credit builder loan is a very small dollar loan whose main purpose is to build a positive credit record for the borrower. And we'll talk a bit more about that loan later. So first, our opportunity loan. It ranges from $100 to $1,000 with an interest rate of 18%. It is an installment loan that can have a term up to 12 months. And we work with the borrower to see what monthly payment fits into their budget. Most borrowers ask for the full 12 months with the understanding that we have no prepayment penalty. We do use security holdback. So, for example, if we approve a loan of $500, we disperse $425 and put $75 or 15% aside in a special bank account called a borrower's deposit, where it serves as a security holdback. That security can be used for the last few payments of the loan or dispersed as a check at the completion of the loan. If the loan is charged off, that security holdback reduces the charge-off costs. We do report our loan payments each month to the credit bureaus through our membership in the Credit Builders Alliance. And we encourage the automated clearinghouse payments, but we do not require them. Housing-related expenses often include things like late rent payments, or being used to avoid eviction, moving expenses to get to a better place, utility bills, late fines, really anything that's going to help someone stabilize their situation. Oftentimes we see people who are having a cash flow problem. Maybe they've gotten into a cycle of overdrawing their account. And working with our coaching and the loan, we can help them get back on track. This morning I approved a loan for someone who had an overdue medical bill, and the hospital offered her a reduction of 30% on what was due if she pays it by August 1st. But she couldn't afford to pay the full amount due. She could afford our loan, so she used that to pay off the debt. That's a good example of how a loan can help someone take advantage of an opportunity to pay off a reduced debt. Our referring partners find this loan useful for their clients who may not be ready yet to take advantage of asset building programs, but need a little bit of stability and a stepping stone to get closer to participating in a home buyer program, or a micro enterprise program, or make room in their budget for an IDA. Rather than outright denying someone from their asset building program, they can send them to us, and we can help the client build a more stable foundation from which they can access asset building opportunities in the future. Our loans are not open to the public. We lend on referral from our partners. So again, our partners are resident service providers, social service providers, staff of asset building programs. So they provide the character collateral for the borrower by making the referral. Our loan size is up to 40% of their net monthly income or take-home pay. So for example, let's say someone's take-home pay is $1,250 a month. Then 40% of that would be a loan of $500, and that would be the maximum they could borrow if it can fit into their budget. We really want to make sure the borrower can afford the loan, that they're not getting over-indebted, and that they're thinking strategically about how to make the best use of this opportunity to borrow from us. The orientation and closing meetings are the time for this in-touch education, the time to review their budget and make sure they can afford the loan. Our financial stability plan asks about the use of the loan. Usually the loan is not enough to cover the full entire identified need. So we help the borrower identify what else they'll do to make up the difference and what they'll do in the long term to move forward and improve their situation. We don't allow garnishments, but people do use our loans to avoid garnishments or to get through those last few months of a garnishment. If we see someone who has a pattern of overdrafts or bank advances or payday loans, then we do require some coaching before we'll approve a loan. If someone has a heavy debt load, then we refer these folks to emergency resources, such as emergency rent assistance or food pantries or utility assistance. And if appropriate, we can refer them to ways to work to refinance their car loans. Then we welcome them to take advantage of our free credit coaching and attend our classes, so they can become a bit more stable and less debt burdened before taking out our loan. Our referring partners know their clients and what they need, so they really do a great job serving as character collaterals. One of the things we've learned is what we've actually learned from the payday industry, which is make these loans convenient, fast, easy, do a quick turnaround. What may be a little different than payday lenders is we're very transparent. We have no hidden fees. Everyone knows everything up front. Our orientation and closing sessions are times for building the relationship and providing learning moments. So we spend a lot of time reviewing the loan documents and explaining the truth in lending statements so people know exactly what the loan is comprised of. We always message that we are here to help in our verbal communication and our written communication, and we're willing to modify the loan to meet the needs of the borrower. We're very flexible. We can do deferrals of payments or go for interest-only payments. What's most important is that the borrower is contacting us and being proactive in managing their loan. So we're always willing to work with them in that way. Each week, we review our delinquencies by aging report and make calls to our borrowers to keep them on track with some gentle and friendly persistence. We have a scripted checklist to take throughout each stage of delinquency to really keep in communication with those borrowers. As you can see from the actual uses, there's quite a variety there, and it's really based on each borrower's unique needs. We always encourage people to look for alternative, low-cost ways of funding their needs, but if they don't have a more affordable alternative, they can come to us. We do have delinquencies, and we do charge off after 120 days, and if this borrower has been silent, if they're working with us, then we'll hang in there. But if we've lost them, then we do run through a charge-off process, and we're in the process of starting to analyze our charge-offs to look for patterns to really enhance our underwriting to reflect the findings. Our current charge-off rate for our entire portfolio is 14.2%. These quotes represent some of our most common borrowers. So our first one is managing a medical expense, and she really thought about what she could afford to pay back, what she could fit into her budget, which is very important for her. The second one was someone who was really struggling with payday loans. And not only were we able to help him break that cycle, but he also learned how to negotiate with the collection agencies and reduce his debt load. And now he's got a much more positive outlook on how to manage his money moving forward. And then the third borrower really hits the nail on the head when she talks about the recognition of paying off all of her liabilities, giving everyone a piece of the pie, but working with us, we were able to give her a loan that fit into her budget, so she was able to do that. You can really see the relief in her comment there, being able to manage that debt load. Now let's talk about the credit builder loan. The credit builder loan is a very small dollar loan whose main purpose is to build a positive credit record for the borrower. We report their monthly payments to TransUnion via our membership with the Credit Builders Alliance. You can see the zero interest loan with a few fees there. In August, we'll start charging a loan processing fee to help offset some of the costs of managing the loan. This loan is 100% secured, which means we do not disperse the funds at loan closing. We set the funds aside in a bank account, and we call the borrower's deposit account. We disperse the funds to them when they complete their loan payments, and in that way, it's kind of a savings product. We've accumulated their payments for them. Having the security holdback means that this is a no-risk loan, although it is not a no-cost loan. Let's look at who the credit builder loan is good for. Again, we use our referral network, and our two main referrers for the credit builder loan are the home buying programs at the Portland Housing Center, which is a NeighborWorks charter member, and our Portland Community Land Trust, which is called Proud Ground. This loan is a very simple and cost-effective way for someone to increase their score so they can qualify for a lower-cost mortgage. And as we saw with Vicki's presentation, that can translate into savings of tens of thousands of dollars over the life of a mortgage. This loan is a good second chance tool for people who've made mistakes in the past and who are now ready to build a fresh start. So it's good for people with a low credit score, people who've gone through bankruptcy, and people re-entering society after incarceration. About a third of our borrowers have no score when they come to us, and that's common, of course, with recent immigrants who are just learning to navigate the American financial system. And we also see potential for young adults out of high school to become credit builder borrowers, to start off with a strong credit file and then to make sure they maintain it. Our underwriting parallels that of our opportunity loan, and starting in August, we're expanding our intake for the credit builder loan, where we'll allow any of our borrowers who are in good standing with us to make referrals to us, so they can refer family, friends, coworkers, someone they know can benefit from a credit builder loan. We think this is a great way for our successful borrowers to share their positive financial behaviors with those close to them and build strong credit scores within their communities. Also, starting in August, anyone who's completed our 4-part financial education workshop can apply for a credit builder loan. Again, the lessons learned are similar to the opportunity loan. Be fast and easy and convenient. Have no hidden fees. Everything's up front, very clear about the terms. And train and nurture your partner relationships well. They're crucial folks out there for referring people to us. We do a lot of auto payment, ACH, with the credit builder loan, but still we invoice and we nudge reminders that the payment will be coming out of their account in a few days. We'll start using text message servicing to do that nudging and to affirm successful payments each month. We do want people to keep the loan out for 12 months because prepayment defeats the purpose. The score is built by the 12 on-time monthly payments. In addition to the loan, we do review the credit report with the borrower at month 0, month 6, and month 12, and we discuss other actions they can take to pay down debt, correct errors, and negotiate with collections. At the 6-month mark, we offer a referral to the borrower to a local credit union for a secured credit card so they can further build their file with a positive line of credit. For so many people, the credit scoring mechanism is a huge and intimidating mystery. This product, combined with education and coaching, is a powerful way for someone to proactively work on the good stuff, as Vicki would say. You can see from our these 3 quotes are from credit builder borrowers, and you can see the first ones are folks who went on to purchase a home, and that loan really helped them improve their score and give them hope, and especially hope associated with people who are entering into home ownership. Our second example there is someone who took out a credit builder loan after bankruptcy, and really that loan was showing how we can trust people to give them a second chance so she could go on and become a business person. And the final one, again, was becoming a home buyer. And she very clearly says, thank you for trusting me as a client and being a committed part of your program. That's exactly what we want, that sense of being trusted and belonging to our program. So that concludes our formal presentation. I'll turn it back to Kim.
And I'm going to turn it over to Vicki.
Hi again, everyone. I mean, I think it was so interesting seeing how kind of I started the conversation around that word of trust and trustworthiness and really what does credit and creditworthiness mean. And you could see in that very last sentence on the slide, unplanned, Nancy kind of really reiterate that, well, her client did, in fact, right? That concept of who's going to trust me first, right? When I got through foreclosure, got through bankruptcy, had a hard time, have a bad credit score, who's going to take that chance? Who's going to build a trusted relationship with me that I can then leverage to build a credit history that will then enable lots of people to see that I'm trustworthy? And so kind of how we started the presentation is that's how we end it. Well, unsurprisingly, we have a lot of really good questions here, so I'm going to try to moderate some of the ones that came through for my presentation. Then I have a couple of questions for Nancy as well about her program. Great questions. Does starting a new credit account improve the credit history faster than paying down debt? And and you added on that could be very effective because participants can be more enthusiastic about paying new accounts on time. So it depends on the kind of debt. If people have an ongoing, open, active credit card or mortgage, they obviously want to be paying that. That is getting good stuff going by getting any active account that they currently have going. But if you're talking about collections debt, judgments, then unfortunately, once those become negative accounts, they're really negative accounts. And in fact, we've seen people's scores go down once they start paying those off monthly. So we really encourage you to think about how you're helping people settle debt, how you're helping people get out of that debt. But yeah, in fact, starting up a new account at that point, we've seen people with $7,000 or $10,000 worth of debt. If it's mostly unpaid payday loans, already gone into collections, that stuff's going to be aging, and it still needs to be there, and you're still going to want to help people pay it off. But starting a new account, you'll see amazing things happen to people's credit score, and that's obviously a really good positive because it does excite people. They'll start seeing some wins. They'll start seeing themselves being able to successfully pay off a loan while they're also saving to pay off debt. And so you're using a lot of different asset building tools there to help people both build credit, pay off debt, start saving. And obviously, from anybody's budget, those all have to be integrated. But by helping people start to build credit first, whether it's because they have an open account that they need to get into good standing, or they don't have it, they only have collections and then they need to open up a new account in order to do that. So yeah, that's a very successful strategy that we've seen. A lot of questions about pulling credit reports. When a consumer pulls their own credit report, there is never a negative change or any change on people's credit scores. Only when they're requesting credit, and then those inquiries when they go to a lender and they're asking. But there is some shopping around, and we actually have a lot of other information on that, which we might not get to today, but you can be assured that whenever people pull their own credit report, they're not having any negative. And in fact, when we set nonprofits up to pull soft inquiry reports, that's what we mean, that we're setting nonprofits up to pull reports in a soft inquiry way, which means that there'll be no negative impact or no impact at all on a credit score. Somebody else asked if there was a way for low-income clients to access their credit scores for free. And then there was another question about Vantage Score, and so that's some of the answer. There are very few ways to get a FICO score for free. Sometimes when you're working with a lender and the lender's already pulling it, they'll share that score with you, but they're not sometimes supposed to, and I know some lenders don't. There are a lot of scores available now for free online, but I haven't seen any that are really FICO scores. But the Vantage Score is available in a couple places online. We work with TransUnion and their the TransUnion Vantage Score is available for free at creditkarma.com, and Quizzle.com offers an experience score. Lenders are using a lot of different scores. They're using a lot of other scores, and all of these scores come from the same data. So the Vantage Score is just another way of scoring what's already in the databases, just like FICO does. So it's using the same exact data that Fair Isaac would be using, but just scoring it in a slightly different way. And we're really excited about Vantage Score. We're looking at some partnerships with them. We did a whole webinar with them a few months ago, which we will be making available in the coming months online for people to listen to it. And we got a lot of really interesting information going back to that debt question. If there's a collection on a credit report that's less than $250, they actually ignore it from the score, so it doesn't even negatively impact the score. So the smaller collections that many of your clients might have may not even be having a negative impact on some of the scores. So So we do encourage you to use any score. We like the idea of, for consumers, Vantage gives scores from an A through an E, and we like that, right? Everyone should be an A, right? How do we just get people to be an A, to have a credit report that will give them an A score regardless of the scoring algorithm? Because there's actually 100 different kinds of fair Isaac FICO scores. In fact, there's not just one FICO score. There's one for housing, there's one for car dealers, there's one for insurance providers. So, really getting fixated on any specific score, FICO or not, is really what you want to be helping people think about is, do I have an A score? Do I have a C score? How do I get to an A score? And any of the algorithms are similar enough. They're really looking at the same stuff, but they'll really help be able to support you in your work. So I would go for any of those free scores that are out there. As I mentioned, CBA does have a relationship with TransUnion that would enable nonprofits to sign up to pay, relatively low cost, about $5 or $6 for a report that includes scores, includes the Vantage score. It can include a Fair Isaac score for certain purposes, and that's a huge opportunity for nonprofits and housing counselors to be able to do that. It's another way of empowering yourself to work in the credit building field. Somebody asked if IDA deposits can be reported to the credit bureaus, and unfortunately right now, no, none of the credit bureaus accept that data. But we were really excited about thinking about that. We've been talking with some alternative credit bureaus for a few years, and we're still actually talking with a couple of new initiatives. And so as soon as we can figure out how to make something like that happen, we'll definitely be telling the IDA world. But right now, unfortunately, no. So we have worked with a couple of IDA organizations to figure out how they can still integrate credit building, how they can even leverage the IDA savings to make sure as a way and encourage savings, either to leverage the savings or to encourage savings. And we'll be doing that presentation and highlighting a couple of those at the ALC, and we'll probably do a follow-up webinar in the fall for those of you who can't come to DC, although we'd love you to come. So there are really a lot of opportunities now for IDA organizations to integrate great credit building in a very effective way. There's so many ways to approach a local financial institution, and local financial institutions, from credit unions to local bank partners to national bank partners, all have, obviously, as this person mentioned, different experiences in the past of working with low-income clients. And so what we really, how are you helping to demonstrate what value add your organization is going to bring to those in terms of client acquisition for them, which is as well as maintenance, and that the client is going to be successful with the products that they can offer. And I think that there's a lot of really great ways that we've seen nonprofits, and I'm trying to think if I can think of any specific examples, but I'm going to actually use that question as a transition to Nancy, because she may have some examples of how they've particularly partnered in Oregon. And yes, sadly, Innovative Changes are only in Oregon, so those of you in North Carolina and other states cannot access and be a referral partner to Innovative Changes. We'd love for there to be an Innovative Changes in every state, and we'd love to support any nonprofit initiative to kind of start where Innovative Changes started 3 years ago, or where some of our other members started a year ago, and think about, what ways you can support low-income asset builders in your state, and Credit Builders Alliance is available for that. So if you missed some of the specifics on how our Access Project works, yes, many people in your staff can look at a credit report, but only on your staff. If you missed some of the how-tos on becoming and reporting to the credit bureaus, please email us at info@creditbuildersalliance.org, and we would love to talk to your organization through the specifics that would work for you, because we offer free needs assessments for any organization that's thinking about being a credit builder, and we're happy to do that with you. Because cash is not an easy way for clients to build credit. So there are opportunities for, if you have a small loan and clients pay you in cash on a small loan, and I know that we have, I'm sure Nancy can talk about, they like ACH to happen, but they have many of their clients coming to them and paying off those credit builder loans in cash, and that's the way that they can use cash to build credit. So with that, and with the last 5 minutes of our webinar, I'm going to pass this off to Nancy to answer maybe some of that financial institution, the cash question, and then how long your loan terms are. And then I have a couple of other questions if you have time for those three. So Nancy, are you around?
I am. Can you hear me?
Great.
Okay,
You want me
super. So the first question is about
Perfect.
So the first question is about banking relationships, and probably what triggered that was that we did the referral for a secured credit card. So we have a relationship with a local credit union that has that secured credit card. It's a $150 secured credit card. And, you know, really the way to get that relationship is to just shop yourself around and find the credit union or the local bank that has a similar mission to you. When you find the right one, you'll find that it's actually very easy to find ways to work with them. So just get out there, knock on doors. We focused on local banks and local credit unions, but regional banks would also conceivably be receptive, and larger banks. So get out there and see folks have shared missions. And yes, there's a sense of acquiring new clients and acquiring clients for whom we have tested the risk on them. And so they're going to be clients who are going to do a good job maintaining their accounts. So there's definitely value added for banks and financial institutions to having our clients sent over to them. We also have a relationship with a local bank that has a second chance savings account for people who perhaps were on check systems and cannot get a bank account. And so again, based on our referral, that local bank is willing to give them a second chance savings account. So just keep working on those relationships, and slowly but surely it will come together. The second question was about cash payments. And yes, we have a lot of our folks who do pay in cash. We have them come to the office in person and make those payments, and we can then forward report them to the credit bureau. It does not have to be in the form of a check or ACH. So we do have a fair number doing cash payments. And, you know, we work with people with where they're at. And if they've decided that right now it's not right for them to have a bank account, we respect that. If they change their mind over time, then we'll help them navigate how to make choices around their banking services. But we try to work with people where they're at. The third question was about the length of the loan. So the opportunity loan can be up to 12 months, and typically that is the length of the loan. We work with our borrower to determine that length and to see what fits into their budget. And most commonly they do ask that it be the full 12 months with the understanding that there is no prepayment penalty. So if they're able to finish up the loan early, they really enjoy coming in and doing that. And we're really pleased when they're able to do that. The credit builder loan is a 12-month loan, and we do encourage people to keep it out for the 12 months. There can be the 12 monthly payments reported to the credit bureau. That's really the strength of the loan. We do find that when someone is using a credit builder loan and they're working towards getting qualified for a mortgage, if by month 9 or 10 they've gotten that mortgage, it's fine to stop on our credit builder loan. They've achieved the goal they were working towards. And so we just close out that loan and send them the funds that they have accumulated so far. But in general, we do try to keep folks in the credit builder loan for 12 months.
Great, thank you, Nancy. Those are really good answers. I think we need to start wrapping up, and I just wanted to I think you really accentuated, which was really helpful, that any credit builder loan, especially an installment loan, whatever length it is really, you're going to want to be graduating from each other loan product, right? Because it's only going to build credit for the length of time that they have that loan. And so if they're moving into a mortgage, if they're moving into a car loan, then that's obviously the next step. For those who aren't, the secured credit cards are also really great steps, especially if they have some savings that they've worked on with you to get to that point and feel more confident. Other just bigger things, just as, you know, around building those relationships. There's some exciting national initiatives, as I mentioned, with some of our partner organizations around a nonprofit secured credit card platform that was just piloted this year and has already onboarded 20 nonprofits. And so that may be an opportunity for some of you in states where you don't have local financial institutions to eventually think about onboarding that. And there'll be, as I mentioned, a lot more information coming out about that, including at the Assets Learning Conference. Some other kind of next steps that we just talked about. Obviously, we got a lot more questions that we didn't get to, so feel free to either email those to the email on the slide or to info@creditbuildersalliance.org, and we'll try to respond to as many questions offline that we can. Obviously, Assets Learning Conference in September, we talked about a lot on this call. I also wanted to mention that for the first time, Credit Builders Alliance is working on taking this credit building as asset building training that we have, which you saw a few slides of. We actually have 2 days worth of material that takes you through those 5 steps in a really comprehensive, interactive way. And we'll be debuting that at the NeighborWorks Training Institute in February in Atlanta. So it'll probably only be spots for like 30 people, and we know there's like nearly 500 people on this call. So be one of those 30 people. If it's very successful, that'll be something we'll be looking at continuing as a partnership with NeighborWorks. Obviously, there's a lot of interest, and we've got a lot of stuff. Many of our members are already NeighborWorks partners, but we're really obviously excited to continue to partner with NeighborWorks and CFED, and we're just thrilled about all the interest in credit building and that it came to those partnerships, and we're really grateful to CFED and NeighborWorks for inviting those Credit Builders Alliance and Innovative Changes to present today.
And I'm just so thankful on behalf of CFED and NeighborWorks that we were able to have both Vicki and Nancy join us today to give us a very good sense of what does it really mean to build credit, what does it look like, and what are some of the exciting leading edge next steps in this work. So thank you both, and we hope we'll see many of you in September at the Assets Learning Conference. And if you have any questions about that, just feel free to go to the assetsconference.org website. Thanks, everybody. We're signing off. Bye-bye.